Welcome back. You're listening to the Keeping Your Money Show. Everyone has goals to retire, travel the world, or buy a vacation home. Financial success doesn't happen overnight. It takes time and planning. Take the first step and get your complimentary financial roadmap from Jamie himself. Call to schedule your appointment at 1-888-986-6639. And now, the hosts of the Keeping Your Money Show, Jamie Westenbarger and Bart Steinler.
Welcome back to the Keeping Your Money Show. This is Bart Steinler. I'm joined in the studio today by Shannon Simon. And, we just got done with a really nice holiday week here. Mm-hmm. And I got to tell you a little story. I was heading up to northern Michigan, and my wife was in the mood for a frozen Coke from Burger King. Okay. Oh. So I don't usually stop at Burger King a lot because my diet, I don't eat a lot of fast food and stuff. But so we pull in there, and I go up and order her a frozen Coke. And there's two cash registers, and the person next to me is a guy with his young son, and he's ordering whatever. And the gal tells him how much to pay, and so he gives her a $20 bill and some change. And the gal looks at him, and I guess she wasn't really well trained on the cash register yet.
Or at least the change probably threw her off, is my guess.
The change threw her off, and she says to the guy, Are you very good at math? And the guy goes, What? He goes, Are you very good at math? And the customer is like, Yeah, I'm pretty good at math. She goes, Well, good, because I'm not. So could you tell me how much money I'm supposed to give you back? And I'm like, I can't believe this, So if you own the Burger King in Kalkaska, you might want to put a little extra effort into the training of the cashiers there, or you might find your drawer coming up a little bit short.
Well, at least to be thrown off. And that kind of ties into the article we're going to talk about a little bit, and underestimating expenses and not calculating it right.
Right.
For Social Security taxes. So
we'll segue into that. This is another article that Shannon brought to my attention. This was from USA Today, and they were talking about the taxation of Social Security benefits.
Yep. So it's basically the article context is there are 37 states that do not tax Social Security benefits, and there's 13 that do. And I think Michigan is one of the states that does not tax Social Security benefits at a state level, but there are potential implications that it could be taxed at a federal level. So keep that in mind. And I think specifically the IRS uses an income test to determine what portion of Social Security benefits are taxable for federal income tax purposes. And they define the combined income as 1/2 of your Social Security benefit and all of your other sources of income, even non-taxable bond interest could be included in this figure. So there's different details behind this in explaining the way that they tax it. And I think the where I wanted to talk about, Bart, was less about, I guess, being aware of the tax implications that you have when you're transitioning into retirement, whether you're on Social Security or not. And I think one of the why this came up is in conversations with people that have made the transition or thinking about retiring, and you have an income need. And let's just throw a hypothetical number out there that says you need $1,000 a month in income. What sometimes people tend to forget about is you have to pay taxes on that money if it's coming out of a tax-deferred investment account, IRA, 401k, some type of tax-deferred vehicle. You're going to have to pay taxes on the money you draw. So realistically, your net income could be less than the $1,000 if you're paying taxes on it. What ends up happening is you have to withdraw more money to be able to cover the taxes in that. And I think the key piece that we've talked about in the years that I've been with you guys and doing the radio show is having buckets of money allocated for different purposes.
Right. So as an example, a lot of times we encourage people to, if they are eligible, to start a Roth IRA, mm-hmm. or to look at ways that they can overfund a traditional IRA, which can later be converted to a Roth IRA.
Correct.
And by doing that, in retirement, if you draw money out of a Roth IRA, that is not going to be part of the calculation of your taxable income.
Mm-hmm.
So that you can be drawing income that you have money to spend without bringing yourself up into a tax threshold, which is going to cause more of your a larger percent of your Social Security to become taxable.
Right. And I think that if anything that I can take away, or I want people to take away, is just understanding the different sources that you have to draw income from. And like you said, finding a smart way to withdraw that money to minimize your tax implications on that. And I think part of that comes down to having a team approach where you have your financial professionals working with you, working with a tax professional, with an attorney, to be able to structure your accounts the right way for your situation, making sure that the withdrawals that you take are factoring in the implications for taxes and so forth, and then being smart with the distributions that you do have coming out of different accounts. So sometimes it makes sense that you can draw it out of a Roth IRA to where that's a tax-free growth account. I'm doing air quotes like anybody can see that. Versus a tax-deferred account is a traditional IRA, 401k, 457, whatever vehicle that you save that money in. And then, more importantly, having some what you call non-qualified or non-taxable or tax deferred accounts, like your just regular savings account, that you've accumulated money for those purposes. And being able to strategically draw money out of those to cover the expenses you have, but also keeping in mind the most important piece is whatever income you need in retirement, if you're drawing it from a taxable account where you're going to pay taxes on the money, you need to anticipate the fact that you might have to take a higher withdrawal rate to cover those taxes.
Yeah, now we mentioned Roth, and in the last segment we were talking about health insurance costs.
Yes.
And you mentioned one of the ways to plan for some of those health insurance costs may be to set up an HSA.
Correct.
Now, could that also tie in to a way of getting income that is not taxable? Like if you have built up a certain amount of money in your HSA, let's say you've built up 30, 40, 50,000 in your HSA over the years, and you haven't used it to pay smaller medical expenses, but you've kept track of those medical expenses. Yes. Now that you're in retirement and you need to draw some income, you could actually say, well, I've paid for these, medical expenses. Here's $12,000 of medical expenses I've paid for. Now I'm going to take that money out of my HSA. That's bringing cash flow in that is not adding to your taxable income.
Yeah, and I think the best way to say that is as you're younger.
I thought I said it pretty good.
You did.
Okay.
From my standpoint, I think the point I want to make is that as you're younger, your health costs are going to be less. So as you get older in retirement, you're going to have those bigger expenses. So what I take from that is, in lieu of taking money out of a retirement account because you have medical expenses, you take it out of your HSA account to offset that expense. And I think the key thing is, for me, is thinking about if you're younger and you're accumulating assets and you're eligible for an HSA account, that's another vehicle to be able to defer that. And when your expenses get and you're older and you got greater medical expenses, that's where you're able to maximize that. So
right,
absolutely.
Okay. And then real quickly, sometimes people have a lot of cash value in a life insurance policy, and some of that cash value could also be drawn out of a life insurance policy without adding to your taxable income.
Yeah, and that's one of those things. If you've got a strategy like that, or if you have questions on that, you certainly can talk to someone either on our team or a professional that can help you identify that. But if you do have that is a tax-free option to withdraw money. I mean, there's some very specific details that you have to make sure that you do or don't do in that arena, but absolutely that's another vehicle to offset some taxes.
Okay, so if some of these ideas are bouncing around in your head, you want to talk some more about them, you want to look at how they could help you in your plan, you can give us a call at 1-888-98-MONEY. That's 1-888-986-6639, or email us at info@keepingyourmoney.com. We will be right back to talk with Nate Boonstra, and he's going to have some information about what's going on with Social Security disability on the Keeping Your Money Show.